Welcome back to the weekly review with me, Siti Norabsa Jusfa. Alright, now if you grew up watching the cartoon Inspector Gadget and is a fan of the movie Inspector Gadget starring Matthew Broderick, no, this is not about either one of that, but it's about how you can revolutionize your shopping methods. GadgetMan aims to convert into a franchise program by year 2014 and venture into cooperations efforts with neighboring countries in early stages. Newcomer GadgetMan is the world's first end-to-end e-commerce licensing program and offers a specially structured program to support Malaysian entrepreneurs and second income aspirers. Sherilyn Pang has more details on how GadgetMan is set to transform the shopping behaviors. Let's have a look.
In an increasing competitive environment, GadgetMan strengthens entrepreneurs in providing consumers with a fast, affordable and secure way to purchase gadgets. Integrating mobile apps with secure payments and a robust product ordering and delivery brings a new customer-oriented solution to busy shoppers who want the freedom of being able to purchase gadgets from any location at any time from trusted sales personnel. GadgetMan is believed to create a new global standard for m-commerce to secure mobile shopping with instantaneous cashless payments between individuals, merchants and banks using tablets as credit or debit card terminals. The main company's goal is to enable entrepreneurs around the region to utilize the GadgetMan platform to provide products from the directory. Shopping behavior may switch permanently with this device from conventional stores and e-commerce to the human touch in m-commerce through GadgetMan. CEO of GadgetMan Syndrome Berhad, Raymond Woo, said that GadgetMan is a leading innovator in creating business platforms for entrepreneurs, citing it as the first of its kind in the world. GadgetMan is working in partnership with Maxis, who will be providing data plans and Samsung tablets for the service or program.
This product is the only one in the world at the moment. We will be looking at partners who would like to offer this licensing program other part of the world, anywhere, Singapore, Vietnam, Indonesia, so long as there are data coverage for internet connection for doing a transaction, then anywhere is possible.
The GadgetMan provides a new and innovative way of selling and purchasing gadgets, which will enable entrepreneurs to get a hold of their gadgets anywhere and anytime. Dubbed as the human touch in mobile commerce, with just the availability of a tablet, the network connection and credit card, you're on your way to business. Sherilyn Pang, The Capital.
Alright, now moving on, there are concerns that the US labor market could be softening going forward. Affin Investment Bank said in its research note recently, the US trade deficit narrowed from $53 billion in March 12 to $50 billion in April 12, but slightly larger than the market expectations of $49.5 billion. The narrowing trade deficit was caused mainly by the sharper decline in US imports relative to exports.
First of all, we need to understand that the US trade deficit has narrowed slightly, but it is still larger than market expectation. Okay, we expect it to be $49 billion. It turned out the trade deficit was $50 billion. We can see that the biggest contributor to this narrowing of trade deficit is definitely the reduced imports, especially from China, and secondly from Europe. We can see on structural basis, total imports fell by about 2.7%, and these imports fell by a bigger magnitude than the exports decline. We can see that the decline in imports was primarily due to the drop in consumer goods, which is about 6.3% drop, and then a drop in autos as well as in auto parts, which is about 4.2% decline. The next one was a decline in the capital goods, which is about 1%. And finally, it's because of the decrease in import service by about 0.7%. As by country, we can see that the biggest imports fell was due to the reduced import from the mainland China, which narrowed sharply to $19.4 billion. We also see that the imports from Japan as well has come down. We see the deficit with the European Union also narrow sharply to $5.9 billion. This is about 5% decline in imports. So overall, we can see that the biggest contributor is because of reduced import from China, as well as a reduction in the consumer goods, as well as in the autos and auto parts goods.
On a month-on-month basis, growth in imports fell from 5.2% in March 12 to 1.7% in April 12, while exports from 2.4% to 0.8% during the same period. Demand from Europe, China, and other parts of the world slowed significantly during the month. The narrowing trade deficit gap from the drop in the U.S. imports also reflects a slower Asian exports in the months ahead.
I would say if you make a little bit of studies, you can see that most of the economists would answer that in a contingent manner. They would say that the adverse impact of the slowdown U.S. import would depend on the severity of the import slowdown itself. And number two is how long of this import is going to be, the slowdown import is going to be. If the slowdown in the imports is short and shallow, then we believe there may not be so serious impact on Asia as well as on the rest of the world. This is because we believe Asia still has a strong domestic consumption to weather this import slowdown in the U.S. However, if the slowdown in the imports of U.S., of course, the slowdown in the U.S., the economic strength is more severe. In other words, the length could be, say, last more than 12 months. All right, then we believe that is likely to have some impacts on Asia. We need to understand that the impact on Asia can be of two ways: the direct as well as the indirect. We believe the direct impact is not so big. This is because we know that the ASEAN exports to the US is only about 20%. But the indirect impact of ASEAN can be more serious than that. This is because lots of ASEAN countries, they actually export intermediate goods to the other countries, which then export to US. In other words, the indirect impact can be bigger than the 20% the direct impact, which most economists estimate to be around 30 to 40%. For example, we can see Thailand, which does not export directly to US, but they do export intermediate goods to China, which then China exports directly to US. So if the US have a serious marked slowdown in the imports from China, obviously this is also going to impact the exports from Thailand to China as well. So I believe the interdependence of Asia to US is slightly more complicated, especially if you look at the indirect framework, which means the exports of intermediate goods to other countries, which then export to the US.
On the US services sector, the US Institute for Supply and Management, ISM, for the non-manufacturing sector rose slightly from 53.5 in April 12 to 53.7 in May 12, higher than market expectations of 53.4. The ISM non-manufacturing was supported by the new orders index from 53.5 to 55.5 during the same period, followed by a business activity from 54.6 to 55.6. However, increases in these major subcomponents were negated by the fall in the employment index from 54.2 to 50.8 during the same period, consistent with the slower growth in the services payrolls. This also indicates that the rise in services sector employment's payroll will grow at a slower pace in June 2012. However, the U.S. initial jobless claims fell by 12,000 to 377,000 for the week ending June 2, 2012, from 383,000 in the previous week. This was the first weekly drop since April 12. However, in continuing claims, for example, total number of laid-off Americans receiving unemployment benefits rose by 34,000 to 3.29 million, which reversed a 19,000 drop in the previous week, signaling that the U.S. labor market conditions remain uncertain. The rise in continuing claims highlighted that the U.S. Fed's concerned after non-farm payrolls figure from May 12 was at the slowest in 11 months. Last week, U.S. Federal Reserve Chairman Ben Bernanke told lawmakers that the situation in Europe poses significant risks to the U.S. financial system and economy and must be monitored closely. He added that the Federal Reserve remains prepared to take action as needed to protect the U.S. financial system and economy in the event that financial stresses escalate. Separately, U.S. Fed Vice Chairman Janet Yellen, in a presentation to Boston Economic Club, also highlighted that there are a number of significant down risks to the U.S. economic outlook, and hence it will be appropriate to ensure against adverse shocks that could push the economy into territory where self-reinforcing downward spiral of economic weakness would be difficult to arrest.
Again, I think this question should be directed to the Federal Reserve officials. We believe they're working very hard now to reduce the direct impacts of this, risk on the economy. Of course, from monetary point of view, they need to focus more on other measures that can reduce what we call this export slowdowns. Maybe they need to focus more on personal consumption. They need to reduce overspending, I would say. Perhaps we know already that interest rates have been low enough. They may have to use some creative, what we call non-interest rate measures. For example, injecting liquidity by long-term bonds. I think most important, we talk about imports or exports here, trade. The most important thing is to avoid a trade war with other neighbors, or to avoid currency war with other neighbors. I think at the end of the day, the U.S. may have to resort back to their relationship, especially with China, maybe with other BRICS, Russia, India, and Brazil. This is because these are the four countries which is likely to be the biggest, what I call, exporters to the U.S. I think the other thing that they can do perhaps is to encourage more foreign direct investment by the countries direct to U.S. Those that have more resource and more creative business should be allowed to operate directly from U.S. Flourish back the U.S. economy. They can also do other things such as to reduce this massive personal debts, what we call debt traps, where overspending can lead to more higher uncontrollable personal debts, which I think they need to control that. At the end of the day, I think what matters is that they need to identify what is the causes of all this slowdown. Is it a single cause or is it a chain of issues? I think is bigger than that. What's important for them right now is that to ensure that the confidence remain high, and to take some steps to ensure that business activities or environment is conducive to stimulate more business activities.
As a result, some market participants expect that the U.S. Federal Reserve monetary policy, which is guided by a dual mandate of economic growth and inflation, to remain focused on stimulating economic growth in next week's FOMC meeting on 19 to 20 June 2012. There is a strong possibility for the U.S. Federal Reserve to provide further policy accommodation either through its forward guidance or through additional balance sheet actions. Phew, some heavy stories there, but don't worry, we're going for a short break. Don't switch that channel just yet. We'll be right back after this with some lightweight stories, alright? Stay with us.